Here's a detailed summary of Dell's Q4 FY25 earnings call transcript, designed for clear and concise delivery. Intro. Good afternoon, everyone, and welcome to the Dell Technologies Fiscal Year 2025 Fourth Quarter Financial Results Conference Call. I'm Paul France, Head of Investor Relations. With me today are Jeff Clarke, Vice Chairman and Co-Chief Operating Officer, and Yvonne McGill, Chief Financial Officer. Overall FY25 performance. Jeff Clarke. I am proud of the team's execution this year. Dell Technologies delivered strong results, exceeding our long-term value creation framework. For fiscal year 25, we achieved revenue of $95.6 billion, an increase of 8%, and generated operating income of $8.5 billion. We also reduced our operating expenditures by 4% over the course of the year, leading to record diluted earnings per share of $8.14, up 10%, and cash flow of $4.5 billion. This performance highlights our successful modernization efforts, making us more efficient and enabling further investment in innovation. Key innovations and strategic positioning. Jeff Clarke. This past year saw significant innovation across our portfolio. We launched 5 platforms for our AI-optimized portfolio, including the PowerEdge XE9712, which was the first to ship NVIDIA's NVL72GB200 globally. We also introduced advanced cooling solutions and expanded our AI PC leadership with Copilot Plus PCs and Intel Meteor Lake commercial PCs. Our strategy is focused on extending AI from large-scale cloud providers to enterprise workloads and out to the edge via PCs. We are extremely well-positioned to capture growth across every segment, driven by our unique operating model, leading product positions, and robust go-to-market engine. Q4 FY25 financial highlights. Yvonne McGill. Turning to the fourth quarter, Dell delivered revenue of $23.9 billion, up 7%, driven by robust Infrastructure Solutions Group, or ISG, growth. Our gross margin was $5.8 billion, or 24.3% of revenue. Within gross margin, we discovered previously unrecognized accumulated credits from suppliers, which will result in revised financial results reflecting higher gross margin and increased earnings per share for relevant periods. Operating expenses decreased by 6% to $3.1 billion, and operating income increased by 22% to $2.7 billion. This resulted in net income of $1.9 billion and diluted EPS of $2.68, up 18%. ISG performance. Yvonne McGill and Jeff Clarke. The ISG segment demonstrated strong performance in Q4. ISG revenue was $11.4 billion, up 22%, with a record servers and networking revenue of $6.6 billion, up 37%. We saw AI orders of $1.7 billion and shipments of $2.1 billion, with an order backlog of $4.1 billion that has since grown to roughly $9 billion. Traditional server growth continued, up double digits, driven by customer consolidation for power efficiency. Storage revenue also grew 5% to $4.7 billion, marking the second consecutive quarter of growth, with strong performance in PowerStore and PowerScale. ISG operating income reached a record $2.1 billion, up 44%, with an operating income rate of 18.1%, up 480 basis points sequentially, driven by improved gross margins in storage and reduced operating expenses. CSG performance. Yvonne McGill and Jeff Clarke. In the Client Solutions Group, or CSG, revenue was up 1% to $11.9 billion. Commercial revenue grew 5% to $10 billion, a second consecutive quarter of year-over-year growth as customers await AI PCs. Consumer revenue, however, was down 12% due to softer demand. We are ready for the PC refresh cycle with a simplified brand, leading go-to-market engine, and focus on commercial PCs. Cash flow and capital allocation. Yvonne McGill. In Q4, cash flow from operations was $0.6 billion. We returned $1.1 billion of capital to shareholders, including $6.4 million in stock repurchases and a dividend payout. For FY25, we returned a total of $3.9 billion to shareholders. We announced an 18% increase in our annual dividend to $2.10 per share and approved a $10 billion increase in our share repurchase authorization, underscoring our confidence in the business and our cash flow generation. FY26 Outlook and Guidance. Yvonne McGill. Looking ahead to fiscal year 26, we expect revenue between $101 billion and $105 billion, a midpoint growth of 8%. ISG is projected to grow in the high teens, driven by at least $15 billion in AI server shipments and continued growth in traditional servers and storage. CSG is expected to grow in the low to mid-single digits, weighted towards the second half of the year. We anticipate gross margin rate to decline roughly 100 basis points, primarily due to the higher mix of AI-optimized servers and the competitive environment. Operating expenses are expected to decrease in the low single digits year-over-year. Non-GAAP diluted EPS is projected to be $9.30, plus or minus 25 cents, representing 14% growth at the midpoint. For Q1 FY26, we expect revenue between $22.5 billion and $23.5 billion, with diluted non-GAAP EPS of $1.65, plus or minus 10 cents. Key risk factors and management commentary. AI server competition. While acknowledging the presence of ODMs, management emphasized Dell's differentiated value through custom engineering, integrated services, global support, and financing capabilities. They stressed that AI servers, while margin dilutive in rate, are margin dollar accretive and operating margin positive. PC refresh timing. Management expressed confidence in a PC refresh driven by aging installed bases, Windows 10 end-of-life, and the emergence of AI PCs. However, they noted it's taking longer than prior refreshes, with a slowdown observed in January. Tariffs and supply chain. Dell highlighted its agile and resilient global supply chain, utilizing AI modeling to navigate dynamic trade regulations. Any unmitigated tariffs will be viewed as an input cost, potentially requiring price adjustments. ISG margin pressure. The company anticipates continued competition in CSG and a competitive pricing environment affecting gross margins. The growth of AI servers, while profitable, is expected to be margin rate dilutive. Storage mix shift. Dell is shifting towards its proprietary Dell IP storage, which offers superior margins compared to partner IP. This includes driving growth in PowerStore, PowerScale, and PowerFlex, while acknowledging a secular decline in high-end HCI. U.S. federal government exposure. Dell does business with the U.S. federal government, but cannot parse out specific percentages. They express confidence that technology needs, including AI, will materialize despite potential budget fluctuations, and their broad business can navigate these cycles. Free cash flow decline in FY25. The decline was attributed to lower than anticipated CSG growth and significant inventory investment in the AI business. For FY26, they are optimistic due to improved inventory levels, expected CSG growth, and P&L improvements. CEO and CFO key statements. Jeff Clarke, Vice Chairman and Co-Chief Operating Officer. We grew our company while reducing our operating expenditures over the course of the year. Our modernization has made us more efficient and provided us the ability to invest more in innovation. We are extremely well positioned to capture growth across every segment of our business and extend AI from the largest at-scale CSPs to enterprise workloads and out to the edge with the PC. Regarding AI server competition, every time I look at this question, I look at the differentiated value we are bringing to the marketplace with the Dell company bringing end-to-end solutions. And right now, it's valued on AI server margins. AI servers are margin rate dilutive. They are margin dollar accretive. They are operating margin positive. They are profitable. On FY25 performance, FY25 was a strong year. We delivered 8% revenue and 10% EPS growth with $3.9 billion in capital return to shareholders. Yvonne McGill, Chief Financial Officer. We delivered strong profitability, specifically in ISG. Our total revenue was up 7% to $23.9 billion. This was driven by continued strength in servers. As our modernization efforts continue, we expect OpEx to be down low single digits year over year. On FY26 guidance, we expect revenue and EPS growth in FY26 above our long-term value creation framework. On PC refresh, these represent prime candidates for upgrades. Reflecting on the end of life for Windows 7, we acknowledge that we have substantial progress to make in these next 9 months. Closing. Thank you for your time today.